Specialist in mid-caps, Anshul Saigal, is joining us on the show to discuss his special situations Kotak fund, which has done phenomenally well over the last 10 years, I would say. Anshul, good afternoon. Thank you so much for your time. You have, very meaningfully or reasonably outperformed the index over these 9-10 years for this special situation fund. And we'll come to the ingredients, but talk to us mainly about, in short, if you could, the process of stock picking. Mid-caps is a very risky terrain. It may appear very, lucrative and juicy, but it does tend to be full of landmines as well. So how do you dodge them and still beat the index?
Good afternoon, Ajay. Thanks for having me on your show. As regards our process of investing and identifying opportunities, that stems from our objective. The objective that we are trying to service here is that we are looking for mispricings in the market. And these are mispricings in earning power. What I mean by that is that if a company has the potential to do 10% EBITDA margins, and at this time the company is doing, say, 5 or 6% EBITDA margins, and the street is kind of building in that 5 to 6% in the future as well, then there is a differential in the reality of that business and what the street is actually building in. That differential is what we are trying to assess and actually build into our process of investing, and identify opportunities where this misperception exists. Now, stemming from this, we try and identify stocks where either the earnings are temporarily sort of depressed, or that there is new capacity which is coming in, which will add to business, or there is a restructuring which is happening in the business, which will bring to the fore the true earning power of a company, for instance, demergers, spin-offs, etc. That process is what we kind of undertake from the objective of identifying misperceptions or mispricings in the market. Broadly, that's really what we do. There are various ways in which one can identify mispricings, but that's a very long discussion. I would spare your audience that boring long conversation, but broadly, this is really what we do.
Sure. Let's talk about the other point, Anshul. That is the power of concentration. You've taken, say 20-something high conviction bets in it, and 60% of the portfolio was in 10 stocks. There are votaries of this style of investing. At the same time, some people call it very risky. Talk to us about how did you go about? I mean, I can see a large sugar company, plywood company, a very large phenol kind of a chemical name, and some other engineering companies along with mid-cap IT. Talk to us about this style of concentrated, or it's like sure-footed but concentrated bets, or how did you, navigate that?
Absolutely. So there are two sort of thought processes that exist in the market. One thought process believes that volatility is risk, and the other thought process believes that permanent loss of capital is risk. If you are a votary of volatility being risk, then clearly you need to have a highly diversified portfolio, as many as 60, 70, 80 stocks, which will actually absorb volatility and not and kind of volatility in one stock will not have an impact on the overall portfolio. But if you're a votary that risk is really permanent loss of capital, then even a 20 stock portfolio, I mean, to many people, even a 20 stock portfolio may look over diversified. They may say that as many as 5 to 10 stocks is good enough. Now we fall in the latter, I mean, we lean towards the latter bucket, but we build the portfolio somewhere in between, where we have not a 5 to 10 stock concentration, but say a 20 stock concentration, where our belief is that the names that we have in the portfolio are strong enough, their businesses are strong enough, their balance sheets are so robust that they will be able to ride through any bout of volatility. And for that reason, these stocks don't have the risk of permanent loss of capital. Of course, they will have to bear volatility as markets move up or down. Now, there are two running themes which are there in the portfolio, and this is a vertical running theme. One is that our stocks are largely debt-free. By and large, these companies grow through internal accruals. Now, what this does is that it allows these companies to temper any sort of extraneous volatility which may happen in the environment. So you had a COVID, I don't know if there can be a worse event than a complete lockdown of the economy. And our companies came out thriving, or at least they did not get hurt like many other companies because their balance sheets were strong. They were well capitalized, had enough cash on the balance sheets to run their business through that period of lockdown. The other thing, or the other theme that you will see in our portfolio is that all these names that you mentioned, the sugar company, the phenol company, or even the plywood company, you will notice that these are companies which are leaders in their respective business segments. That these may be small and mid-cap names, but within the segment that they operate or the sectors that they operate, they are leaders. Now, what that allows them to do is that it gives them competitive advantages because of scale, because of their ability to manage capital, as also their other resources. And in an environment like COVID, where a whole host of fringe players go out of business, these companies, in fact, gain market share. So these two running themes, we believe, prevent permanent capital loss in our portfolio or in businesses that we hold in the portfolio. And that combined with a reasonable amount of concentration offers us market-beating returns, which we have demonstrated over a long period of time.
Right. Very quickly, Anshul, what is something new which you are researching or reading right now, which may not be in part of your portfolio, but you are looking for where you see mispricing or valuation differential still existing?
We are working on a contract research and manufacturing company, which in fact we owned in the past. We booked profits and we are looking to add again. Now, this company operates both in the pharma as also the specialty chemical space. And in our judgment and our assessment of its fundamentals, it is trading at a significant discount to most of the competitors. In fact, I would say all the competitors. Largely, it is because this company has not been understood too much by the markets because it has a recent history of having seen a demerger and one part of the business coming to the fore. It's quite recent that this business has kind of split and listed separately. And in our judgment, the space as a whole has tremendous tailwinds, which this company, because of its track record, its abilities, its science abilities, is likely to benefit from for a very long period of time. So, what gives us further confidence is that the company is adding to its gross block to the extent of 2 times the current gross block in a period of 2 to 3 years, and that just tells us what is the opportunity the company sees for itself going forward. A fabulous balance sheet, net cash, and huge growth opportunities. We think that this is a name which can unlock value going forward.
All right. We will, in fact, get one of those rare managements which you were referring to earlier, out of the leaders, chemical leaders. That management usually doesn't talk on public platform, but we'll try and get them to talk about their road ahead very shortly in the next couple of days. But today, very thankful for your inputs. Anshul, always great to chat with you.
It is absolutely my pleasure, Ajay. Thanks for having me.
Let's take a short break on that note. On the other side of the break. All right.